morning.
Good morning.
Welcome to the Teachers Retirement System of the City of New York Investment Meeting from May 3rd, 2018. Dad, would you please call the roll?
Thank you, Mr. Adler. John Adler.
I'm here.
Pleasure to see you.
Thank you, sir.
Thomas Brown.
I'm here as well.
David Kazansky.
Present.
Deborah Penny.
Here.
Raymond Orlando.
You're in my new seat.
Nice.
We hope you're comfortable.
I truly
Upgrade.
am. I love it. Never leave it.
And Ms. Susanna Vickers.
Here.
We have a quorum, sir.
Thank you so much. And with that, I will turn it over to our friends at Rokaton to take us through the public agenda.
Good morning, everyone.
Morning, Mike.
I'd like to just start by quickly apologizing for the delay in getting out some of the handouts in advance, and we try to strive to do that more quickly and more well in advance than yesterday. But some of the materials were delayed for a variety of reasons. But in any event, let me know if there's anything we can be helpful with. We'll start off with the performance for the passport funds through the month of March. The Diversified Equity Fund, with about $15.3 billion at the end of March, was down about 1.8%. And really what drove performance for that month was a negative return by about 2% for U.S. equity markets. Abroad, there was also some weakness in equity markets, with developed non-U.S. markets down about 1.8% during the month, and the custom proxy for emerging markets that we use here was down about 1.1%. So you can see that really drove the negative absolute returns. On the bright side, the defensive composite did protect somewhat by posting a less negative return to the tune of about negative 60 basis points. Not capturing all of that downside. Year to date, the Diversified Equity Fund has a return of about negative 75 basis points, roughly in line with both benchmarks that we used for that. And the other composites are all roughly in line with their respective proxies as well. The Balanced Fund at the end of March, with assets of about $380 million, that fund had a modest negative return of about negative 30 basis points during the month. That brought the calendar year-to-date return to negative 60 basis points, not far from the Diversified Equity Fund. The International Equity Fund assets were about $150 million at the end of the month. That fund is down about 1.7%, roughly in line with its benchmark, and year-to-date that fund is down about 1.25%. The Inflation Protection Fund, with assets of about $60 million, that added about 80 basis points in return during the month. That brought the year-to-date return to a negative 73 basis points. And so far, year-to-date, what's been a little bit of a drag on the performance there have been the performance of REITs and TIPS. And a lot of that has been offset by the stronger performance we've seen in commodities year-to-date. On the Socially Responsive Equity Fund, that fund had about $190 million of assets at the end of the quarter. Return there was negative 1.7% for the month as well, ahead of the S&P 500 index, which is the benchmark for that strategy. Year-to-date, overall fund option is up about 60 basis points, which is about 140 basis points ahead of the S&P. So I'll pause there and see if there's any questions.
I have a question.
Mr. Orlando.
So I'm looking at the Diversity Equity Fund returns, and they just appear to be lagging by 80 to 100 basis points over all periods. That sort of, this is the first time I've noticed that. I guess maybe it's my new prescription of my eyeglasses. But I'm just wondering if there's any light you could shed on that, because that seems not significant, but also not insignificant to me.
Yes, so if there are a couple of sources. The primary source for that is really the actively managed U.S. equity composite. And if you recall, we recalibrated our approach to that composite. We reduced it in the recent past, and we've also developed a perspective that we don't necessarily have to fully implement that target, and that we will do so where we find particularly compelling ideas. So that is something that we've observed for quite some time now, and particularly in the U.S. equity market, it's been a very difficult market for active managers to add value.
Sure. I guess not to ask you to take out your crystal ball, but do you think over the next year or 3 years, the decision to not maximize active management in the U.S. is going to result in seeing, is the ship going to turn?
Well, we've been waiting for it to turn for a long time, so potentially, and actually, if you look at very recent, well, I can't even say that. There has been a gradual improvement in terms of many. If you look at just peer groups, the median active U.S. equity manager relative to benchmarks, there's been an improvement in relative return, and what has been difficult for active managers really only can add value if there's disparities in, what they call cross-sectional volatility. So if stocks behave very differently within the universe, when you have a market in which everything is going up, it's difficult to add value by doing research and distinguishing among securities. So to the extent that volatility stays at close to historical levels, and there is greater disparity among performance with recognition of different stock valuations, that's where active equity managers should add value. So I do think there is potential for active U.S. equity managers to add value going forward, and I think they should start doing that very soon.
Given how long in the tooth the current growth period is, and the forecast of rising rates, can you opine on the likelihood that there will be more volatility and therefore some hope in this sort of ship turning?
Yeah, I think you've seen an increase in volatility, and we have long thought that, particularly once, and Mike can, and we'll talk about this in his part of the agenda, but with QE abating and what some have termed an artificial support for risk assets abating, that volatility should continue at closer to historical levels. So I do think there are reasons to think that there will be opportunities for managers to add value by distinguishing among securities within the U.S. equity market. I do think that is possible, and that is largely the reason we have retained any active U.S. equity management within this portfolio.
Thanks.
Other questions for Mike on the? Are you done with your presentation or not?
I was going to comment briefly on April.
Yeah. Oh, April. I meant on the March. Any other questions on March for the quarter? Okay, go for April.
Okay.
Thanks.
Great. Well, U.S. equity markets in April were modestly positive, just shy of about 0.5%. The broad international composite benchmark that we use for variable C and within the diversified equity fund, that was up about 2%, with particular strength from developed markets and developed small cap, excluding U.S. Emerging markets had a modest positive return to the tune of about 0.25%. The defensive was roughly flat, and all told, we'd expect the diversified equity fund, given its benchmark performance, was up about 70 basis points during the month. So calendar year to date, the fund should be roughly flat in terms of absolute returns. The balanced fund during the month would have been down about 30 basis points. Would have been flat also during the month. There was obviously pullback within short duration fixed income markets, given the rising yields, but also the incremental performance from global equity markets would have served that fund well. Year to date, that fund is probably down by about 0.5%. I commented on international equity markets during the month. The underlying strategy for the inflation protection fund should have added about 80 basis points during the month, bringing the year-to-date return there to also about 0, flat for the calendar year-to-date period. And the underlying strategy for the socially responsive equity fund added about 0.25%, bringing the year-to-date to positive to the tune of roughly 70 basis points.
Questions for Mike on April? Okay, we're good on April.
You want to go on to the next agenda item? Well, Mike Haddad is here to provide a further insight into some of the topics that were addressed at the most recent SIM, and he's really going to talk in detail about the most significant aspects of the asset allocation strategy within the teachers' pension fund going forward. So, Mike?
So there's 2 handouts coming your way, one titled Asset Allocation Review, and the other titled Asset Allocation Review Global Macro Update. The Asset Allocation Review are the slides you saw from Scott on your portfolio as of DEES 31. Same slides, except we took off the other 4 systems, and it's just your system on there now. So let's set that aside to start. We'll refer to that later and dig into the global macro update, because this is what you've heard me rant about for a year now.
Yeah, we don't have it down here yet, I have to say.
That's not it.
Global macro.
It's coming, I think. There's a bet on that.
So there are 2.
Okay.
Yeah, there's
I did mine. Let's not share.
Yeah, there's one.
Those 2?
Yes, there are 2.
Thin one that says asset
The thin one is the one we're setting aside, and the thick one is the one
I have the thick one.
That's the one we're focusing
The thin one I may have brought, I thought I brought, I don't know that, but I have 2 of them.
Do you need some more?
Yeah.
Can you?
You want to share? I can share with And then the other thing I would say, as usual, I have too many slides. I just couldn't cut them out because they're so rich. So please stop me along the way. Let's make this a dialogue rather than a presentation. I think that would better serve the purpose of what we're trying to get to. So on the first page, does everyone have everything now? Page 2 in the global macro review, just try to highlight how unique the environment is that we're in right now. I think interest rates are historically low. I think equity markets are historically rich, and credit markets, which if we get to, I'm going to try and scare you at the end about the potential implications there. And then within the rising rate environment, the real funds rate is still negative, and the real funds rate, as a reminder, is the funds rate minus inflation. And it's very unusual to have a negative funds rate. It usually has to get to +2 or something in a normal state, and then even higher to slow down the economy. And despite 150 basis points of rate hikes, it's still negative. That shows you how low we started. Long duration term premium, which is a geeky bond thing. We got a chart on that. That's negative. Large fiscal stimulus that we talked about a little bit at the last SIM. It's coming, and this coming at a point in the cycle when the economy is running hot, and the Fed is engaged in. I'm now calling it quantitative tightening. They are actually reducing their balance sheet, so it's gone from easing to tightening. And then, this is all theoretical and opinion and blah, blah, blah. And then let's get down to what matters is the portfolio, the concerns about your portfolio. And that is the impact of rising rates on the fixed income portfolio. What could that impact of rising rates be on the equity portfolio while it's historically rich? And then let's talk about the duration extension program that's in place. And then, again, my scare thing at the end about the credit markets, if we get to that. So I want to go back over page 3, this equity market slide, because this one to me highlights the richness of the equity market, and this is independent of what we think about the bond market. You know, we went through this before, but again, this is a valuation model. This is put together by Goldman Sachs Asset Management. This isn't our genius thing. 5 different inputs into the model. The model goes back over 70 years, and the inputs are pretty classical, different types of valuation techniques one uses on the broad equity market. I don't know how they're weighted, but that's what the model spits out. The graph shows you 10 different deciles, divides the time period, the valuations into 10 different deciles, with the right side being the most expensive and the left side being the least expensive. And then what the blue bar shows is what the return has been over a 5-year horizon post each of these decile valuation periods. And we're in the 10th decile on valuations, and historically, you know, so it does, history is only history. It doesn't necessarily predict forward returns. Have been terrible. 0.3% on average annualized. And the red dot shows you the number of observations with a given year when the equity market has been positive. And you can see that red dot is somewhere around 35% when we're in this valuation period. And the other takeaway from this is, outside of the far left or the far right, returns are within norms, within expectations, and not really something I think that would consider us to rethink about the equity portfolio. But we're on that right decile, and that's a big source of concern. So let me pause there, because this one is a key part of the view.
So where were we 2 years ago if we were to look at this, right? Because 2 years ago when we did our asset allocation study and we thought that the bottom was going to drop out of the market any day, and it didn't, where would we be on this chart?
Don't know the exact answer. I'm going to guess 8 or 9. I'm curious.
So I don't know the exact answer either, but I think what you're pointing out is that this is not a new concern.
Yeah.
This is not a new risk.
Right.
And just as rising rates aren't a new risk, right? We've been talking about both of these things for a couple of years now.
Right.
At some point, we'll be right. I don't say that flippantly.
Right.
I say that no one who talks about these risks pretends that they can be precise as to timing.
Right.
And that gets into the unprecedented environment. We've never had quantitative easing before. Thus, we've never had quantitative tightening before. Never seen it. So this history has none of that in it. It has the easing in it. It doesn't have the quantitative tightening in it. We've had Fed tightening, many Fed tightening cycles. So that's incorporated in data, but we've never had the removal of the quantitative easing. Any other questions before I try and get through this? Page 4, same chart. This speaks to valuations between the 3 main sleeves we have within your equity portfolio, US, EFI, and EM. And you know, the very simple takeaway is US is well above its 15-year average, EFI's right on it, and EM is below. So if we were just to allocate on valuations alone, and we ignored the antiquated basket clause, we'd want to shift more into those other markets, but we're constrained because of the basket clause. So this slide I haven't shown you before on 5, and this gets to my point. What I'm going to try and get to here is how long rates are historically low. So the white line is nominal GDP. Nominal GDP, as a reminder, is real GDP plus inflation. And the red line is the 10-year yield. And one of these old rules of thumbs is the 10-year yield should approximately equal nominal GDP. And if you look at this chart going back in time, you know it's been above it, it's been below it, but it's kind of in that neighborhood. And I would encourage you to ignore the downward factor of the global financial crisis. Just because, you know, it was a collapse in GDP that came back. So if you smooth that out, you see that the lines are somewhat similar. And post the financial crisis, when QE started, we've had the 10-year note significantly below nominal GDP. And quantitative easing has stopped. It's being reversed. It's being reversed at an accelerating pace, and you can see the gap between the yield on the 10-year note and where nominal GDP is. So that just kind of speaks to, on a historical basis, that the 10-year note is very low in yield compared to where it has been in the past. The next slide on 6 this is one of the geeky bond things. This is called U.S. Treasury term premium. And what term premium means is the additional yield you get for buying long duration fixed income securities as compared to buying a short term duration security and rolling that over for the same period of time. So more specifically, this is the yield on the 10-year note as compared to the yield on the 3-month bill and rolling that 3-month bill 40 different times. So it's said differently, it's how much compensation you're getting for the longer duration of holding securities. And the takeaway you can see is it's, you know, historically extraordinarily low. There's all sorts of arguments as to why it should be low and why it's not going back to where it is, but even if it goes to something like plus 1%, it's going to be very different. And then the orange line is the S&P, and so one of the takeaways from this is you can see in the period in the early 2000s when you get rising term premium, that's usually rising rates and what happens to the equity market during that time. And then the other takeaway is when we had collapsing term premium, you can see the ramp up in the equity market.
Well, so that's like, this is like, I mean, I don't know what the metric, but this is like crazy. I mean, you look at this, talk about unprecedented.
Yeah, and I wasn't going to show the S&P because of that gap now, and I wouldn't focus on that. What I really want is the takeaway on the term premium and how you're not
That's
getting
unprecedented
we're
just
not
by
getting
itself.
compensated. Yes,
Except for like 1960.
yeah.
But
So
that's a flat yield curve, right? And then at the end
It's
of the day.
yes, it is partially flat yield curve, and it's also the total, the absolute level as well. It's both of those things.
Okay, so the fact that it's so low and you're not getting compensated for taking, sort of locking your money up for a long period of time, what's the next after that? Okay, so.
This is really an argument that yields are very low, and unlikely to go lower, probably higher. And then it's also going to tie into one of the questions about TRS portfolios, what to do on the duration extension plan.
Yeah.
What was that?
What to do with the duration extension plan during this period where we're concerned about rising rates. And then I'll tie that into correlations between the equity market and the bond market in a second. And then slide 7, this is a shorter term slide. This only goes from, I guess, May of last year to yesterday. And what I want to highlight is what happened on Feb 2nd.
What happened on Feb?
Feb 2nd. So before we go to that, let's
Groundhog saw its shadow.
So as a reminder, we got the tax plan in December. We had all sorts of noise about it. So we had a period of time leading up to February where the equity market had an unprecedented January, rising yields, both going the same direction, and the rising yields were not bothering the equity market. On Feb 2nd, in addition to the Groundhog Day, we had the employment number. And what was rattling to the markets about the employment number were upward revisions to average hourly earnings, as well as a very high average hourly earnings for that particular month. So the year-over-year number went from something, if memory serves, 2.3 to 2.9, and that did two things. It caused inflationary concerns that were beginning in the bond market to translate into equity market, and that's negative for equities. That means the Fed's got to raise rates more than what we otherwise thought. And the second concern that the equity market faced with that, if there is rising wage inflation, that's going to eat into profit margins. So it's a combination of the two things, and you can just see from the visual, and here's the break in correlation. So we had yields going up, equities going up, and then on Feb 2nd, yields continued higher at a slower pace in the equity market, that began its 10% correction. And then,
Can you just describe which line is which?
oh, I'm sorry. The blue line is the S&P, and the white line is the 10-year, the yield on the 10-year. And then just in terms of measurement things, so if you measure from Q4 to yesterday, the 10-year was up 62 basis points, and equities were up 4.2. So positive correlation, both moving the right way. If you measure from Feb 1, do a 3-month measurement, you have the 10-year up 18 basis points, and the equity market minus 6.6%. So it kind of depends on where you measure these things, on what the correlation looks like, and you know which market moves in front of the other, because the equity and the bond market are always not focused on the same thing.
Question. And I think this shows you and I have had conversations that illuminate my misunderstanding of basic bond math. But on page 6,
Price and yield are inversely related.
that might be the answer. But on page 6, the S&P, which is orange, is going in one direction, and the Treasury premium, which I assume is similar to the white line on, or the line on 7, they're going in opposite directions. But on 7, they're going kind of the same.
This is a 60-year chart, and the other one's like a 7-month chart. So it's the span. That little wiggle up on page 6.
They both wiggle.
Yes, that's that wiggle.
So can I just interject one thing? I just want to highlight the point Mike made, because that is central to the thesis about taking sort of pausing the long duration investment plan. If you believe that U.S. equities have a risk of declining, if you believe that U.S. interest rates are poised to rise, then what you're really concerned about is the correlation between those two phenomena. And the argument underlying, the primary argument underlying the allocation to long duration bonds in your long-term asset allocation strategy was that in periods of equity market crisis, long bonds often act as a very effective hedge against equity market declines. And because you can get protection against, you can buy hedges in other formats, but the benefit of long treasuries is that they actually pay you while you're holding them. And so the point that Mike just made about correlations trending positive between long bonds and equity markets mean that in a scenario, in going forward, there's a risk that long bonds won't be an effective hedge, and in fact may exacerbate the losses that you realize in the U.S. equity market. That is a really important point.
And just to add on to what Robin said, and I'm in periods of equity stress, we have to decompose what's causing the equity stress. If it's a global financial crisis and what we experienced, and the negative correlation existed, it was a fabulous piece of protection. If it's a period of rising inflation, then it kind of depends where we are in the cycle, and I'll show you a graph on that. If it's, let's do some hypotheticals going forward. If war breaks out in the Koreas, I'm going to guess that the long end is going to go down in yield, and that negative correlation is going to come back.
So long bonds will, in that case, have been a good hedge.
Yes. But where it's not a good hedge is in periods when the economy is running at full steam and the Fed is raising rates to slow down the economy. And then they both go down. And so that gets to page 8. And this is
I have a question.
yes.
My question's about wage growth, which you noted was part of the Groundhog Day incident. Is there some expectation that wage growth will continue, or was it a one-off surprise? is.
I would.
While I keep asking crystal ball questions. I mean,
The expectations will-
I guess I don't. I'm more likely to believe wage growth in a different political environment than the current one, as a longer-term story, even in an inflationary environment.
You get to go back to geeky economics, the slope of the Phillips curve. As a reminder, from your economic textbooks, the Phillips curve is the relationship between the unemployment rate and wage growth. And what we've experienced in this up to now is a very flat slope of that line. So we've had falling unemployment and relatively stable wage growth. It's up a little bit, but a little bit. And it's a debate raging within the Fed, with market participants, is what is the slope of the Phillips curve. The Fed economists, Fed staff would solidly argue it's an upward sloping relationship, and that it will exert itself. The unemployment rate is 4.1. It's as low as it's ever been, just about. It's projected to go lower. There's also different unemployment rates. U3 is the one most commonly used. U6 is a broader one, which incorporates people working part-time for economic reasons, people who are, I forget different categories, but one that's not in there is people not seeking work. That rate is, memory serves, mid-8s, but that's back below pre-crisis levels. So that it's higher than U3, but it still indicates a labor force being tight. So to answer your question,
Fewer people in the labor force. Isn't one of the defining situations today is that the unemployment rate's not reflective of the fact that no one is actually working anymore in this.
That was the point he made about the people not seeking work.
Yeah, but
labor participation rate is down.
Right, but I think there's the seeking, but there's also the not seeking.
Yes, and the labor participation rate is very low. So that's the number of working adults in that, and that's fallen from mid-60s to like around 60. And a big cohort of that is men, like 40 to 60 or something, and it speaks to the opioid crisis.
It speaks to the what?
Opioid crisis.
Although I might suggest it speaks to the William Julius Wilson idea that when work disappears, dysfunction shows up.
The cause and correlation can be debated.
Yeah. Okay.
But you'd see that a big uptrend. And if you decompose the labor participation rate, the place where it's really out of whack is that component, that age component of that. But back to your question, I think the expectation is wages will rise with the unemployment rate this low, and the economy still running reasonably strong, and the unprecedented fiscal stimulus that they hit with the economy running above trend.
Thank you. I now see the argument a little clearer. Not sure I buy the argument, but I see it.
So page 8 ties together what Robin had laid out, and I'm going to do my best to explain this one, so please, I know I'm not going to get it right. The red line is the 40-week rolling correlation between returns on the equity market and returns on the 10-year. The scale on the right is the scale for that rolling correlation, and you can see 0 is about midway through. So when the number is above that, the red line, it's a positive correlation. When the number below that, negative correlation. The blue line is the unemployment rate, and this is an attempt to signal, where the economy is. Are we late cycle? Are we early cycle? Are we at full employment? And what this chart suggests in the two areas where the circles are is when the unemployment rate is somewhere in a declining trend and near below 5, approaching 4, we get shifts in correlation between the returns on those two major asset classes from negative correlation back to positive correlation. And that happened around the 2000s, and that was with the labor market very hot. The Fed had paused in raising rates because of Y2K concerns, and the economy overheated, and they had to raise rates. At the same time, we had the equity market, the NASDAQ crash, all that kind of stuff. And the other time was in the 04 rate cycle, and again, you can see the correlation shifted positive. So that brings us today. where we are at the far right-hand side of this chart. And you can see that we know the decline in the unemployment rate's gone from 10 to 4, and correlations are still running negative on a 40-week rolling basis. And what I showed you from Feb 2nd is there's been a shift in correlations. Now that's 3 months. It's not, it's not robust data. It's very small amount of data. But if you follow my line of argument that interest rates have to go higher, that long rates are historically low, and that the unemployment rate is very low, and that we're going to get a shift in correlation, this would speak to those markets moving together going forward. So that's my source of concern on where we are in the cycle and what's likely to happen to rates and the impact on the equity market.
So you're saying that the red line is going to go up and be positive?
Yes.
Going forward, and
Yes.
the blue
So-
line will keep going down?
Yeah. And that the returns in the bond market are going to be negative, and then if the correlation shifts to positive, if the correlation shifts, then the returns in the equity market are going to go negative too. Then layer that on top of the valuations where we are in the equity market now, and you can kind of see where what keeps us up at night is that probability, that potential of rising rates and a declining equity market.
Sorry, did you just say that you expect the blue line to go down? Or
Yeah, I do. The
below 4?
yes.
Okay.
We do. What would change that is if the labor force participation goes up. Supply of labor goes up. We're doing the wrong. Immigration is restricting labor supply. The change in immigration laws. So that's a negative on supply of labor. Unless we shift somehow the supply of labor, I would expect that to go down until the economy slows.
The great new world of a new natural employment rate. Okay.
So one question that you may not be able to or willing to answer is how, this is your point of view today, what do you think is the investment horizon of this perspective? Because if you look at the historical data, most of the time the correlation is negative. And where there are periods of positive correlation between the 10-year and the equity market, they seem to be pretty brief. So is this something you would expect to revisit in a year?
I don't know. Markets move, they move quickly.
Mm-hmm.
So I don't know what the catalyst will be. I don't know when it will happen, but I do I think it's a short-term thing, not a long-term thing. And I think your point about these are short-term movements and long-term periods is I agree with. And then this would tie into part of our conversation. Is it time for a new strategic asset allocation, or is it time to put some shorter-term tilts, whatever you want to call them, on the portfolio in anticipation of a drop in equity prices, in which we can take advantage of, avoid some of the loss, and then reposition the portfolio back to the long-term targets. And I think that kind of brings together what we're talking about today.
So, just to make sure what you just said is clear, so in terms of moving within the rebalancing rate, which is what was outlined, you see this as a short-term, relatively short, likely to be a short-term phenomenon, or who knows? And I'm not being flippant, but really, who knows?
Yeah, who knows?
Okay.
Who knows? If the equity, we fell 10% and how quickly in 2 weeks in February? It's a big correction. And then we've recovered about half of it. So I don't know. And what would change all of that is a reasonable correction in the equity market, and then those valuation metrics shift. Then you're not so concerned. But it's the combination of the two that has us concerned. So let me just kind of pause there because I threw a lot at you. And any questions on any slides? Thoughts on what we should do, could do, strategic versus tilts? Let's just kind of turn it over to y'all.
So here's my question for both you guys, which is that 2 years ago, so that would have been, 2016, I think, when we adopted the strategic asset allocation. We went in for the long treasury, the extension of the duration on the treasuries as a hedge, right? Insurance. And we have not fully implemented it because of as I understand it, because of the costs. The costs of implementing it have gone up. And also, what I just heard you say, Mike, is that hedge worked in 2008 because the cause of the stock market decline, the equity decline, was global financial crisis. It doesn't appear right now that if there is a further correction, that it would be as a result of financial crisis. So what I'm really sort of asking for is, it seems to me that what's incumbent upon us is to try to hedge the portfolio as much as we can against these conditions that you just described, right? And it sounds like, again, the likelihood of a correction of some sort, based on the key charts that you showed us. But if it's not caused by, what I hear you saying is that if it's not caused by financial crisis, the long duration treasuries may not actually have the intended impact, because at least right now, the correlation, they kind of more correlate with each other and they don't correlate. So you had mentioned in passing earlier, Mike, there are other ways to hedge against that. What are those other ways, and should we consider them, implementing them, as opposed to either not? I mean, so right now, basically, I feel like we're sort of, we're like, what you guys, as I recall, at the meeting in April, is you talked about essentially, rather than going to a target of 18 years on the duration, sticking to about 13 years, am I right on that? Which sort of sounds to me, truthfully, like betwixt in between, and not necessarily providing the hedge that we were told 2 years ago that we would be doing when we adopted the strategic asset allocation. And sort of what I'm saying is, it sounds to me like we need a hedge. So what should that hedge be, and what would be the cost? Or what are the different options, and what are the costs of the different options?
Take a crack at it.
And if I could just add to John's point, it sounds like we need a different hedge.
Well,
If you buy my argument.
I honestly, I feel like we have kind of
Because
no hedge right
there
now.
is the
We're
decision
exposed.
on the treasuries was designed 2 years ago, was it not to be part of the hedge? And I think the question that's being called is sort of, do we need a different hedge?
Can I just piggyback on that
I
also?
could be wrong, but that's what it sounded like.
Because we're long-term investors and we're not supposed to be market timers and reacting to the market, just as soon as things happen. Can you also, when you answer those questions, speak to why we are designing the portfolio to hedge it all?
Yes.
And is that something that we should
Yes.
decide whether we just want to ride it out or hedge?
Half hour's up, next agenda item. So on the plan, we've executed half of it according to the schedule that we laid out with the help of Broken Times. We wanted to get half of it done quickly because we all bought into the thesis of the plan and we wanted that protection in place. Even though we recognized yields were very low and we were likely to lose money on it. And that's okay because it's a hedge.
Insurance.
And the other part of the stuff rocked, so it worked. And now what we're suggesting is we're in an unprecedented time with risks to both the long bond portfolio as well as the equity portfolio. We still believe in the long-term correlation being negative,
and particularly on what's called left tail events, so really exogenous, unexpected, things we can't predict. Those things usually cause the bond market to move differently than the equity market. And by definition, we don't know what they're going to be. We hypothesize about Korea or the Middle East, impeachment, all sorts of different things, but it's going to be something we don't expect. So we have half of it in place. So we have a chunk of the protection, and then with that anticipated shift in correlations, which started on Feb 1, which I would argue are going to continue during the Fed hiking cycle, we don't want all that protection. So how do we protect ourselves now? I would argue we reduce our equity holdings. And then the question is
U.S. equity.
U.S. equity, yes, because of the valuations. And where do you put that money? Because I'm telling you everything is kind of rich. I would argue in the front end of the bond market. So the riskiness of the front of the bond market is 1/16 of the long end of the bond market on just bond math. So we hide in 1 to 2 year treasuries. You could call it cash. It's all sympathetic.
But does that? So let me just ask you a question about that. That makes some sense to me. That flight to quality, right? Go to cash. However, you're also talking about inflation increasing, right? So if inflation is increasing, if you're going into 1 to 2 year treasuries, does that actually provide you with the protection? I'm asking. I'm not asserting. I'm asking.
Yes, because those treasuries are going to go down in price, but you're also earning a 2.5% yield because of where they're valued now and what the Fed has done, and they mature in a very short period of time. So when they expire, that's not the right word. When they mature, and when they roll down the curve, a year from today, they're going to be around the same price, and you will have earned the yield.
And you earn the yield, and then when you put the money back in, you get a higher short-term.
Yes, when you reallocate that money back to long duration when that's moved, or back into the equity market. Yes, so that's the kind of protection that.
And so is that the idea that I think what you said in April was that the idea there is that whatever we have in long now we keep,
yes,
but the overall portfolio we're shortening the duration by going into these shorter term treasuries.
Yes.
Okay.
So we're not advocating selling anything in the long end. We're advocating holding that.
Okay.
But we're going to add to the short end.
Okay. So, Robin, if you don't mind, would you weigh in on what Mike said? And I don't want to put you on the spot.
Yeah, no, you can put me on the spot.
As I recall, when we did the strategic asset allocation 2 years ago, you were a strong advocate for going with the long duration treasuries in order to hedge against the foreseen drop in the equity markets. So what do you think? What do you think about what Mike said, or what would you advocate as far as the best hedge at this point in time in our portfolio?
Just before you explain it, so I had come on the board just when they were doing this reallocation.
Yes.
And I remember it was a big, debate, 5%, 10%, whatever. So when you explain that, so originally we were supposed to have 10%, and we're saying that you want to stop at 5%. So when you explain that, why would you have an allocation set and then stop in the middle of it?
Sure.
That's what I don't understand.
So to clarify one point you made,
Thank you.
we and my partner Matt Malaria is here, and he knows infinitely more about this topic than I do. So I'm just going to make a few comments and let him weigh in. But because he's part of our asset allocation team and actually has done is the architect of a lot of the work we've done for you on asset allocation. But the long bond allocation was a recommendation by us, not only because of where the equity market valuation is, but we see it as a long-term strategic target. And no matter where the equity market is at any point in time, we think it makes sense because, and this is a slight digression, but I think it's relevant. In any portfolio, you have the best hedge against equity market risk is diversification. And you have a very diversified portfolio. You're allocated a lot among the global capital markets, private and public. But the fact is, when you look at the risk of your portfolio and any diversified portfolio, I don't know what the number is, maybe 85%.
92. We
looked at, okay, so as Stan corrected, 92% of the risk or volatility of your portfolio is contributed by the equity allocation, because equities are just so much riskier than fixed income. And therefore, the long bond allocation is intended to balance those risks out. And historically, typically, long bonds have been a very powerful friend when equity markets have suffered significant market downturns. What Mike is asserting and has provided a lot of data in support of is that this time is different for very real reasons, because where we are in the market cycle, because how long the equity market has generated very significant positive returns, because we're in unknown territory. We're going into this, what he called quantitative tightening, and because we passed this big tax bill, tax reduction, and so, you can see in the paper today, we're issuing more and more debt. So there's fiscal stimulus, there's Fed tightening, and so we're in a little bit of somewhat uncharted territory. And in that territory, I don't want to speak for Mike, the argument that Mike and others, right, he's certainly not alone in this, is that long bonds actually may be a very expensive hedge. That on average, long term, everyone still thinks that they're an effective tool, but in the near term, they may be a very expensive insurance policy. And so I can't, and I don't think that would contradict any of the facts that have been laid out, and I think the logic underlying this point of view is sound. It comes to a judgment call about whether we want to go back to the point that Susanna raised, whether we want to ride this out, whether we want to say, over the long term, we think these allocations, having long bonds as a hedge, makes sense, and we understand that there are sound reasons to believe that over the next 3, maybe even 5 years, it might not work as we expect, but we think over the next 20 years it will work, and we're a little. This has been the policy today, or I think the perspective of the board today. We think it's too hard forecasting 3 to 5 year results, and so therefore we're going to ride it out. That would be the basis for I guess rejecting this argument. That's really the basis. It's too hard to predict 3 to 5 year results. And I think the opposite, I hate to say on one hand or on the other hand, but the counter to that is these are pretty extreme market situations. And if we believe that these are very extreme, then it is prudent to step out of the way for a little while. I don't know if you'd add anything.
I don't want to play arbiter here, but they're actually
just sit in the middle.
There may actually be a compromise in some regards, in the sense that, Mike, you talked about actually lowering the U.S. equity allocation, given where valuations are, and that, in my mind, says, well, maybe I don't need as much protection if I'm actually lowering the U.S. equity allocation. So you may actually be able to accomplish both, which says I'm lowering my U.S. equity allocation, therefore I don't need as much protection from the long bonds, which we're proponents of. So that may actually be the compromise in this scenario, in that you can actually both be right, where you still own long bonds, they'll still act as a hedge to the U.S. equities you own, but at the same time you're recognizing that valuations are expensive, therefore I should reduce some of that, and maybe the placeholder is short duration fixed income to the extent that's allowable. But that again sort of may marry the best of both worlds here.
And then I want to respond to your question, Susanna, and it speaks to what Robin said. We've laid out a lot of rationale. We have no idea what's going to happen. We're basing it upon some historical, some market observations, or combined many years in markets as participants, and the risks, and are we getting compensated for the risks? And I would argue we're not in either U.S. equities or long duration fixed income. And so that ties into, do we ride it out? Because we are long-term investors. This pool of capital will exist for 100+ years, serve your beneficiaries. That would argue for not. But again, how unprecedented we are, that would argue for some tweaks around the margin. And then that begs the question, when you're doing that, when are you taking it off, and when do you say you're wrong? So if we're going to get on board for this, you should hold us accountable for answering those questions for you.
Is it time to do a new asset allocation study?
Well, that's sort of what we're, in a way, what we're discussing. We said we're going to review it after 18 to 24 months, which is right
This
now.
is it now.
Right.
And for the record, I was asking a question and bringing up a discussion point, not advocating for any one position.
Oh, I heard you advocating. Let the record reflect.
Clearly advocating.
So what Rokaton is, I'm sorry.
Well, I just wanted to ask you a follow-up to Matt, if you don't mind. What you said makes sense to me, Matt, that you, by reducing the equity exposure, you reduce the need for the hedge, right? But I think the question I have is, are you talking about reducing strategic equity exposure, or what Scott had told us in the meeting in April was that, and I'm looking at the thin deck, thank you, where on page 2, on the growth, the target is 30.9%, I guess, and the range goes down 5% from that. So Scott talked about lowering the allocation within the range, and then if you turn to page 4, he talked about increasing the treasury allocation within that range, which also has a 5% range. So, I mean, in theory, I guess you could do dollar for dollar. But the other question about that, I don't think that we have, I don't know, refresh my memory, it's not on here. Do we have a duration range? In other words, we had set a target duration, according to this, of 17.4, I remember it being 18%, or I guess it is 18%. And the current duration is 12.6, right? Am I reading that correctly?
Yes. Yes.
And so is there a range on duration around the target? There's no range.
No, I don't think that was defined. But I do want to make a point that I should have made clear. Everything we're talking about today is talking about operating within the current IPS targets. There is no change to the strategic allocation. This is simply the BAM saying we want to move to the edges of the rebalancing ranges.
Or in that direction, maybe to the edge, maybe to the somewhere between neutral and the edge.
So, when we did the asset allocation work, there were like Monte Carlo scenarios run, right, to see all the different kinds of possible outcomes going forward. Is there, or was there any of that stuff done with this so that we could get a sense of, is it even, I mean, you may be right, somebody else may be right, and ultimately it's $1 difference here or there, and we're just expending all this air for not much real difference down the road in 10 or 20 years as far as where we're going to be. So my concern is that I understand that we're in uncharted territory, but tomorrow could be completely different uncharted territory. And if we're not looking at all the different scenarios, right? Is this exercise even, does it, I know it has value, I'm not saying it doesn't have value, but is there a point to it if down the road we're really just going to be where we are? Like, there's really not going to be a monumental change in the returns that we're looking for over the long term. Maybe I'm looking at it too simplistically.
I would argue there's a big difference. So let's call the value of your portfolio to $100, and that some of the concerns that we have are actualized, and we don't change anything. Let's say the value of your portfolio falls to 92 over the next 2 years, and then it compounds at 7% for the next 20 years. So that's example 1. Example 2, we do a couple of the tactical shifts, and the value of your portfolio falls from 100 to, let's call it 96 instead of 92. we're compounding at 96 now for the next 20 years versus compounding at 92. It's a big difference.
Mike, is to get to that point, because that's an important question. This is a battleship. Making this change, does it really turn the battleship? So Mike just pointed out how the compounding effect over time is really important, and any losses you avoid at this point compound out over this 100-year horizon, which is really important. There's another very simplistic way to look at this, just to get a sense of the orders of magnitude, and that's what Mike is passing out, because this is a question we asked ourselves, and we shared this with Mike. And so if you go to page 4, that Matt talked about what we've done here.
Yeah, essentially what we've done here is taken the two different portfolios that are, if I can call them that, two different scenarios that we're debating of, do we own long duration or do we not, and tried to frame out what the different outcomes might be for those two portfolios. So the current target, which we've labeled there on the left-hand side of the page, is in fact assuming you are at your full long duration portfolio. And then what we're calling the modified target on the right-hand side of the page is a portfolio that owns some long duration but also owns short duration fixed income. So much more similar to what Mike has suggested. And both these charts, they assume the same starting portfolio market value. And what we've done is
it's about $72 billion.
Yeah, that's right, about $72 billion. And on the y-axis, we've plotted changes in the equity market, which we're using as a broad proxy for all the risk assets in the portfolio. And then across the x-axis, we're showing changes in interest rates, so changes in treasury yields. And essentially, you can pick which scenarios you think are most likely, right? So the far upper left box, just to put some numbers to it, that's a 10% gain in the equity market, along with a 100 basis point decline in treasury yields. So that seems unlikely.
So that box says that in that environment, with owning the target allocation to long bonds and the target allocation to equities, if equity markets rose instantaneously 10% and interest rates fell 100 basis points, you would make $6.6 billion. Okay, so that's a great outcome and very unlikely. So keep going.
Yeah, so and again, you can follow through the rest of the scenarios. Like we've tried to highlight a few here, which really are at the heart of this discussion and which we think are much more likely. So the first one that I would call to your attention, which we've circled in the middle of the page for both the boxes there, is simply looking at what happens if equity markets don't change at all, but we get a large increase in interest rates. And the outcome should be apparent that owning a shorter duration portfolio would be more beneficial.
By the tune of over $1 billion.
That's right.
So it's real money.
And this is over what period?
So this is just to be simplistic. This is instantaneous, just to give you a sense of the orders of magnitude.
Okay.
Yeah.
Wait, I'm sorry, I didn't understand. Did you say owning a shorter duration?
That's what the modified.
That's the modified target. The modified target is owning half long,
Oh, I'm
half
sorry.
short.
I'm sorry. Because you're losing less.
Yes.
Sorry.
Same equity exposure,
Yeah.
just less bond exposure.
That's right. Yep. And again, so the other probably two scenarios, we could have probably circled one more here, which are really at the heart of this debate, are those bottom left charts, bottom left corner, which is a significant decline in the equity market, along with a significant fall in interest rates. And then again, the other one which we could have circled would be the bottom far right. So a significant decline in equity markets along with a significant rise in interest rates. In this scenario where rates fall and equity markets fall, you're looking at a savings, if you want to call it that, of somewhere on the order of 400 million.
So I want to emphasize that. The reason it matters much less is because the equity market risk really just swamps. So we're talking about rates rising. What you really care about is equity markets falling.
Yeah.
And if you have a high conviction that rates at the long end are going to rise significantly, you want to get out of the way of that. But what you're really worried about is equity markets falling. And I think by orders of magnitude, the most important thing that Mike has described here is reducing the U.S. equity allocation. That's much more important than, in terms of a risk mitigator, than reducing the duration. I'm sorry, go ahead.
No. I think just about at the end of of any formal comments on this, which is if you again look at that bottom far right column, again a significant rise in interest rates and a significant fall in equity markets, you can see it's much more beneficial on the order of about 1.3 billion or so to own that shorter duration portfolio. So. And again, you can sort of, the reason why we've laid it out this way is such that you can decide or try to think about which scenarios are more likely or less likely and start to weigh the cost of that insurance, if you will. Certainly it's natural that in a falling equity market and a falling rate environment, you're going to want to own long bonds. In the opposite scenario where equity markets fall and rates rise, again, naturally you'll want to own short duration. Again, this simply helps you think about what is the cost impact, and again, which scenarios do I think are more likely.
I have a question. Oh, can I just ask a question about the chart? Because I don't think I'm reading it correctly, or I'm missing something. So if the right-hand boxes are the modified target, which is less equity, I would expect that you would do better.
Same equity. Less. The only thing we were toggling is the duration.
Okay.
Yes.
Then that's what I missed. Okay. But the modified, so it's just the target of
and
the yield.
We probably should have paused on page 3, which actually shows the differences.
What does page 3 show?
It shows the actual allocation, so you can see in the middle of the page there we're showing the current target as well as the modified target, and then the differences.
It's the two options I think that we've been talking about. Just sort of the modified option with the different duration would also have a significantly different amount of equities.
Well, they would have a lower allocation to U.S. equities.
Right.
I think total allocation to, just to be clear, the total allocation to equities I think declines by 1% maybe, because we're increasing the non-U.S.
So would this scenario still hold for what we're discussing?
Largely, what we're really trying to isolate is what happens with shortening duration, and what scenarios do you really care about shortening the duration.
Right. But then, if that's true, then how come with the modified scenario, when the equity markets go down, you're losing more, 15,486 versus 15,107?
So again, the duration difference plays in there as well, right? So that scenario has 100 basis point fall in rates, right? The one, if you're just trying to isolate the equity difference, it's looking at that column which is 0 for changes in rates, and follow that all the way down to the bottom. They're almost the same. There's again a slight difference in the composition of the portfolios, but you can see about a 16.3 billion loss for the current target and 16.1 for the modified.
Okay, got it.
But so what you guys did for modified though, what I heard Mike saying is the idea is to take the
U.S. equity risk.
U.S. equities and not redistribute it to international, but redistribute it to short duration, right?
So let's go back to the growth, page 2 on your portfolio.
The skinny one?
Yeah, the skinny one. So this was a snapshot as of year end, and the first 3 bars are your equity exposure, U.S., EFI, and EM. And if you total those 3, it's roughly 53%. So as of these 30, and your allocation is 50, your strategic asset allocation is 50. So what did we do throughout 17? We let your EFI run, we let the gains accumulate, we let the gains in EM accumulate, and we rebalanced U.S. to keep it at target. So we rebalanced out of U.S. to fund the long duration, we rebalanced out of U.S. to fund some of your private market allocations, and we kept the U.S. right around on target, but let the other 2 run. So as of D31, you were overweight equities. And what these arrows suggest is the inclination based on our analysis is the direction we want to tilt the portfolio is to leave those overweights in foreign equities there and take the U.S. component down. And that really speaks to the different valuations in those 2 different markets. And then, with what would we do with those proceeds? We park it in the front end of the bond market as a place of safety. So that's kind of the way we're
And also, you talked about putting some in bank loans for the same.
Yes, yes.
Right. Is that what is that little green?
The green arrows are
No, but on bank loans on page 3, it's not just a green arrow, there's a green shade box.
that was just our 8 p.m. attempt to get this put together. I'm unable to figure out how to fix
No
that.
problem. I can totally identify with that.
Looks nice.
Okay.
So basically, you're not talking about adding new money to the non-US. You're talking about just keeping it, letting it run. But
Yes.
you're talking about taking money out of the US equity as well as high yield, it looks like.
Yes.
And putting it into the short end of the treasuries as well as some into bank loans.
Yes. The arrows are strongly held views on the direction of those asset classes. And the treasury, we have a green arrow on that. But again, for everything we've talked about, that's the front end of the bond market, not the long end of the bond market.
And so then on the, is there a target? Right now, I think that might be on the page. So as of 12/31, the duration on the treasuries is 12.6 years.
Yes.
And, no, you don't, so, but you don't have an overall on your chart, Matt. So what would be the target duration for the treasury portfolio?
So this is at the April sim, we introduced another metric for you in fixed income.
Yeah.
Dollar value of a basis point.
Yeah.
And that's on page 6. So there's a couple different ways to look at your treasury portfolio. Duration is the one that I think is we're all comfortable with. But in the environment where we sell U.S. equities and buy short-end treasuries, the duration of your portfolio is going to shrink. Just because we're adding assets which are shorter duration, do your calculate, it comes back down. But what's going to happen in the dollar value of your basis point of your portfolio, it's going to increase. So the dollar value, this speaks to the difference between a 2-year and a 30-year. The dollar value of a basis point is what helps you understand the relative riskiness. So the longer maturities are more risky. And how do you measure that? You measure it in duration, or you measure it in, again, the GT bond math is DV01. So the dollar value of a basis point, the 2-year note is, you guys can help me on this one.
DV01 for 2 years.
For a 2-year, it's very small.
Yeah, like $4 a
Yeah.
basis point or something,
Yeah.
and the bond is 16x that, so it's more like 40 something. But when you're adding 2-year notes, you're adding DV01 to your portfolio. It's not as powerful as one. So by doing that, we're going to shrink duration. It looks like we're going back on our plan, but we're not. We're not going back on our plan. We're actually increasing our exposure to the bond market. We just have to measure it in a different way.
I'm sorry, can you just explain this dollar value?
I can't believe you're going into DVO.
But I do not, I'm professing my ignorance as usual. I don't really understand this measure because, at the sim, it was very variable per pension fund, and I was told that has to do with the amount of assets. So can you explain what
I'm trying to tie together that we want to increase our exposure to treasuries, but in the front end. And when we do that, the duration of your portfolio is going to shrink, but your exposure to the bond market goes up. And how do we capture that? And if you have a better way of capturing it, I'm open to suggestions. But I thought dollar value of a basis point was a good way to try.
We typically think about it, and I think this is almost the literal definition, is for every basis point move, so the 10-year, if it goes from 299 to 3, one basis point move, you would lose 8.7 million in your bond portfolio. And it works the other way as well, of course. So if 10-year goes from 3 to 299, that's a 1 basis point drop, you would gain 8.7 million.
So given that we expect interest rates to rise, right? We have this rising environment, and the Fed is signaling, so given that, why would we be wanting to increase the amount that we lose per basis point increase? Because that is a measure of how we're increasing our hedge.
By increasing in twos, we're adding minimally to the dollar value of a basis point. If we increased in 30s, we'd be adding significantly higher dollar value of basis point. So, and what this captures is your whole portfolio across all maturities, and we're doing it on a small basis. And I'm not in. I think it's the part of the board. It's our choice of asset classes that's going to get hurt the worst in this scenario that we're concerned about.
Choice of asset classes is going to get
Equities versus bonds.
Yeah.
So this is the target in terms of percentage allocation, not
With the 10% allocation, yes.
with the 10% long?
Yes.
Okay.
And this is where we sit today. And again, we're about 50% of where we started when we made the strategic asset allocation, when you all approved that.
So what was the number when we started, the dollar value per basis?
It should be on the chart. I'm going to guess it's, just ratchet it down. That same difference between these two is 50%. It would take
Difference percentage-wise or dollar-wise? So in other words, like dollar-wise it would be about 3.4. So it would have been 8.7 minus 3.4. Is that the idea?
No, it'd be the 12.1 minus 8.7. What is that? 3.4, right? So subtract 3.4 minus 8.7.
That's what I just did.
Okay. Oh, that's not dollar. Oh, I thought you meant AUM.
You said dollar value per basis.
Carry the one.
DBO1. Come on, John, get it right.
Well, I'm just trying to. Honestly, you guys are way beyond, my level here. I shouldn't be announcing that in public, but I'm just being honest.
Well, that's what we have them for. That's why we
Just trying to help explain another way to look at your exposure to the bond.
You're a fiduciary.
So
You're a
let's-
fiduciary with good outside expert support.
Yeah.
So let's one more outside.
So I think all Mike is trying to point out is that we've talked about in general in the fixed income as a generic homogeneous exposure, and having $100 in 30-year bonds is very different in terms of risk if rates rise than if you have $100 in the 2-year. And that's the only point of this. And it can make a real difference in terms of dollars.
So in other words, you're saying that by raising the dollar value per basis point, we're lowering the risk. Is that an accurate statement?
No, you're not going to move to, so you're not moving, right? What page are you on?
I thought you said
Page
that's
5 and
target.
6. 5 is duration and 6 is DVO.
Yeah, I'm talking
Okay,
about. I'm
so
on page 6.
so he's on. You told us to go to 6, so we're
Yes,
on
sir.
6. So this is where you're proposing to be with the 2 years, right?
No, this is a snapshot on these
Okay,
31.
and then the 12.1.
Is the target if we had the whole allocation to long.
Oh, okay.
Okay,
I thought
so
that
that
was your
wasn't
revised
correct.
target.
No, this is
He's not
Oh, so
proposing
it's
to move to the 12.1.
So you're
The
proposing
strategic
to actually
asset.
move down.
Now, DVO1's going to go up. When you buy 2-year notes, it's going to go up small.
So
But
what's
duration's going to go down big.
what's missing here is what happens when you reallocate to more 2 years. So this is where you were at year end.
Yes.
We're going to be in between 8.7 and 12.1 because he's suggesting putting more dollars into the 2 year. But we're not going to. But under this plan, we're not going to go all the way up to the 12.1 immediately.
So at the June sim, when we look at the Q1 portfolio, and we've done the things that we've talked about, if we do them, you're going to see the duration. And what we'll do is we'll do this. We'll do a D's 31 view and a March 31 view. You'll see the duration will have gone down, and you'll have seen that the dollar value of basis point will have gone up.
But not all the way.
Not all the way, barely.
I'm going to call on Antonio.
2 questions regarding to timeline and attribution. Actually, I'll start with the attribution question. Given, we've had scenarios before in the past, and before you got here, Mike, where we did have tilt in a different direction. In this case, we won't describe the tilt, but, at the time at least, our attribution analysis wasn't, I guess, robust enough to kind of capture the effects of this change versus the strategic portfolio. Do you believe that our current risk system will be able to capture that? Is there a way that we could capture the attribution for this decision? And then also, given, then added on to that, the timeline, like, how long, or when do you think this will kind of be in effect, and then will we be able to start getting attribution on this fairly shortly?
Yeah, so we give you attribution now on excess return. We break it into asset allocation or manager effect. Yes, we'll be able to, if we implement these tilts, we will be able to give you P&L on those specific ones, and we can break that out for you. When? Yeah, I'm trying to think whether it's 2 months or 6 months, but it's in that range. You know, we're moving quickly with MSCI, and one of the work streams that we have in place is how to capture this P&L, because we need to have P&L on this, which speaks to having an objective on it and where we're wrong. Because we don't want to, if we're wrong, we don't want to just sit in it. You know, we want to reverse it. So yes, we need those tools to be able to monitor that.
I don't know if people are done discussing.
Is it time for my question yet?
Oh, sorry.
Yeah, go ahead. Sorry.
Sure.
I apologize.
That's okay.
I skipped you over.
It's not
just
personal.
one of my many.
New seat, same treatment.
I can't even see.
New seat, same treatment. Okay, so I am in the Rookton deck that looks like this. Unless you're playing along at home. So I'd like to ask the panel of experts, and you can self-define that. So which is the most likely scenario, guys? At the end of the day, thanks for circling those 4 boxes, but it doesn't feel like those 4 boxes are the most likely scenario. So could you draw my attention to what anyone considers a likely scenario? Thanks. Don't all go.
Well, so I think what we're the temporary fall to the long bond implementation would be is based on the belief that we're going to realize some sort of decline in equity markets accompanied by some sort of rise in interest rates. And so I don't think anyone on the panel of experts is going to specify what level, but it would be, you know, just to call your attention to something that is, let's say, 100 basis points rise in rates and a 10% decline in equity markets.
Turn the southeast quadrant of the boxes.
Yeah, which would, and in that particular box, in the current target, that would be a loss of 6.7 billion. And in the modified target, in the same box, you would save about $600 million.
Yep. Okay. Anyone else want to play bingo with me?
So in the southeast quadrant, which I was also thinking, then under any of the scenarios, we do better with the modified than we do with current, right?
Right.
Whereas if we were in the Northwest, which I think none of us think is where we're heading, we would do better with the current than with modified. Right.
Right. And in the, you know, Southwest, you'd be worse off with the modified. Any environment in which rates fall further, you'll want the full long bond implementation. And this is, and that's an obvious statement, but this gives you some orders of magnitude. It's hundreds of millions of dollars under any likely scenario.
You know, I don't know if this is possible, but you know, I always feel like we sit here and make these decisions about asset allocation, and it's like, okay, and you actually never go back and look at, oh, what would we, suppose we had made a different decision, how would we have done? Mm-hmm. And you know, obviously 20/20 hindsight and all that jazz. However, I think it is, you know, for example, capital markets expectations never play out according to expectations. They might be directionally correct, but sometimes they're not, right?
At best.
Right. I mean, for example, nobody expected 2 years ago that the equity markets would have performed the way they did, the way they have, right?
Correct.
And, you know, so we all expect equity markets to decline as per the Southeast quadrant at this point, and who knows? They could just not perform to expectations again over the next 2 years, 4 years, whatever.
This is all probabilities.
It's probabilities, right? Anyway, in some ways, especially given that we're doing this tactical reallocation, or that's what you're recommending, I think it would be very interesting to sort of go back and review how the bet has played out since in other words, we're making this, assuming we're going forward, here we are in the second quarter, beginning to make this play, and then, you have these two likelihoods here. How did it actually work? Looking at it in 6 months, in a year, in 2 years, something like that. I guess what I would do is ask Bam if you could figure that out for us.
So, same thing Antonio asked, or you want us to?
Yeah, I think it's attribution. That's what you're
Okay.
asking for,
Yeah.
right?
All right, sorry.
And can I make a suggestion, just in terms of,
Great minds think alike.
We spent too much time together.
just in terms of concrete next steps, I think the board has two decisions to make. First, to kind of whether we are comfortable with BAM directionally tilting the portfolio to the edges of some asset classes because of everything that we've discussed today. Not changing anything that's targets that are in the IPS, just understanding that we might go up to the limit in certain asset classes. And that's something that's very short term and something that I think we're kind of directionally doing, and my personal opinion is that we should continue to do, and that's something that I think they need our feedback on sooner rather than later. Some of the attribution and the further study might be a decision that would play into an overall decision and discussion about whether we want to do another strategic asset allocation at this point. So I think that there's kind of like a short-term thing that we can do that I'm comfortable with, sort of making the decision without further study, and then there's further study that might play into whether we want to do a strategic revisit of the portfolio.
I just have a question. I don't think that, did we get your Rokatan's current capital markets expectations? Have you distributed that?
Distributed last week.
I'm sorry.
Yeah, I think we sent that to all clients last week, so you should have
Last week?
received that.
Okay.
Yeah. We can recirculate that on the board mailing. If that's helpful.
Okay.
And John, what we've asked Rokatan to do, and they've done, was to update the asset allocation with their revised capital market assumptions. And I know you did that for us as your DEIS 31. I don't think we saw it for March 31.
Probably not.
But it's a mini version of the strategic asset allocation, and I can't remember exactly where it came out, but I think you might be 100% agreement with our directional arrows.
Yeah. So quarter to quarter, the numbers don't tend to change very much.
Right.
But I do think there is value in going back and looking at the assumptions that were built in to the study several years ago, saying what has changed in those assumptions, what has changed in the environment, is there anything, or what has changed in our risk posture and perspective. So I think there's value in doing that, even though our capital market assumptions don't change much over 90 days.
But I think I would ask you to share your 3 to 5 year capital market assumption on U.S. equities.
Yeah, it's
It's not exciting.
I think it's something less than 4 percentage points, 4% on average.
For U.S. equities.
Yeah.
It's zero for the next 3 years, roughly.
Years,
Your
and then-
capital markets expectations is 0 for the next 3 years?
2.8% for 10 years.
And that speaks to the valuation situation. What drives their return expectation is valuations is a big part of it.
It dominates, yes.
And what was it 2 years ago? Do you have to remember that?
A couple percent.
Probably don't.
It was higher. Probably closer to 4.5, I would guess.
So we did not see, to be very clear, we did not see what happened in 2017, and
Well, I guess just to defend it for myself is that when we do this work, while we show you kind of the expected case, we do build in a very wide range of outcomes. So it was in there. It was certainly at the upper end of those expectations.
we were much more optimistic about non-U.S. equities and emerging market equities, which did actually play out. Yeah.
Well in excess of your.
So,
Well, in excess,
in response to your question, Susanna, what I would suggest, what I would ask is, I don't think we should answer the question about strategic asset allocation today, because I think we want to get this additional information and analyze it and so on. But I think the first question you asked is, are we comfortable with this tactical direction that BAM is proposing? I would ask the board, is there comfort with that as a immediate, because actually you really want to put this into effect. And so I would ask if there's
Right, and I think it is happening.
It is happening. I guess when we put it on reverse, is anybody uncomfortable with saying to BAM, yeah, that's the right direction to go right now?
Well, I guess my question is that when we voted on the asset allocation and we voted on the rebalancing ranges, the understanding is that it wouldn't necessarily be needed for us to interject as long as they were moving
Correct.
within those rebalancing ranges. Were there any caveats to that as far as a time period or rationale behind it?
No, and I just want to jump in. I think the reason why we're even discussing it today is because we are at this extraordinary point, and the mayor's office had asked for a review of the strategic allocation. And so BAM's response to that was, we're already kind of doing this strategic tilt. Tactical tilt, sorry, it's not strategic at all.
It's within the strategy we're executing.
Nice. So we just want to make sure that everybody's on the same page. What BAM is doing is completely within the rebalancing ranges that BAM, kind of has discretion, but, we want to make sure that everybody's comfortable and everybody's on the same page. So it's not like an action item that we have to vote on, it's just, is everybody cool with it?
That was exactly what I was trying to ask.
If I can channel my inner Scott Evans, I think what he says, like, I'm not going to tilt the portfolio. I don't believe in it. We're not good at it. It's hard to do. Blah blah blah. And when I've gotten him over the hurdle, and it was a high hurdle, is we're at extraordinary time periods, and that extraordinary point in time in the markets and valuations, and that argues for doing some within the existing ranges, some of that. And as either Suzanne or John pointed out, these are these 30-month snapshots. I'm not going to comment on what May 3rd snapshots look like. I will say they're different, and we want to be transparent, we want to inform, and we want to get your temperature whether this is okay or not. And if it's not, then we'll do appropriate action, and if it is, we might do different appropriate actions. And it's public session. I don't want to comment on what we're going to do, but
I just want to make one comment on this too, which is that in 2008, virtually every pension fund got slammed, and that's a technical term, but the correlations went. Everybody was correlated and so on. The one exception that I'm aware of, and Rob and Mike, you may know others, was the GM pension fund, and they went to cash, big time, and so they survived. I mean, when I say they survived, they didn't have the double-digit drops that virtually every other pension fund had. You can look at that, and I was very impressed that they did that. Obviously,
Did they reinvest back into the market in a timely way?
Yeah, after the crash.
They did?
That's my understanding.
After the crash or after the market was up here?
No. They, in other words, they went to cash when the market was inflated, and then the market crashed, and then I believe, I don't know if they timed it perfectly because you don't know when the bottom is, so they might have done it on the way up. I'm not 100% sure, but my understanding is that they went to cash, and so they survived much more so than every other pension fund that I'm aware of, the drop. Now, we're not, obviously, we can't time it, and B, we're not going to take on that kind of thing. But the fact, honestly, I find it very reassuring that what you're basically telling us we're going to do with is rebalance into a greater cash position, because I think that given this description of the market conditions that we're in, that is probably the safest place to be in terms of trying to minimize the drop that we anticipate through equity decline and interest rate rise. So that gives me some. Anyway, but I agree, we don't have to make any decision today, but I really just wanted to see if, as of today, trustees are comfortable with the direction that BAM has laid out for us. Is anybody feel like, nah, we gotta put the kibosh on this? No. Okay.
I guess I feel like when we made the decision 2 years ago to go into the long duration, we made it at a point in time, and we should recognize that as time goes by, more data points appear, right? Things either go the way you expect them to, which never happens, or other things happen. And this action is us recognizing that the world has changed a little bit, and we've got more information to make better decisions with. And so I'm comfortable within the strategic allocation that we decided on not to exceed with this decision to move a little closer towards the high end of the range, personally.
Right. Okay. Let me just say thank you to Mike and to the whole Wokaton team here. I thought this was a really good discussion, and you are illuminating things that, for speaking for myself, about which I need to be illuminated. So, appreciate it. Okay, so I think our next agenda item, we are running very late, but so we go, is the Verite presentation.
So they are waiting outside. We have their presentation, and
I mean, it's going to go.
Where do we want to put that? There's one person.
just one person. So okay,
I'll move back. I'll clear this chair for
okay, thank you.
I was asking about the Verite. I didn't think it was electronically distributed.
Most important thing they're focused on. So it really helps.
Heavier than I expected. Aggressively thrown.
He's a voting member. I'm not doing it.
We got to help him. He's the one that kept that chart of correlations during the
And with the new improved seat
Okay, yeah, that was very good.
you're like Supreme Court justice.
It's
Like, you know, Supreme Court justice.
I know, but I know.
Yeah.
Supreme Court justice is your annual like class structure. The more senior you are, the more you get to like sit, stand, and Ray is slowly moving toward the track.
He's like, you don't know
I use it so frequently. Okay. Welcome. If you would please introduce yourself for the record, and then the floor is yours, and we really want to try to keep this to 30 minutes. Totally.
So maybe I'll just make a quick introductory comment. So we'd like to welcome Sean McDonald from Verite. You might recall at the last meeting we discussed a broad review of the emerging market equity country screens. And as part of that review, we're considering an alternative approach to thinking about how we look at the different factors that we previously had been screening on, and how under a new approach we might think about that a little bit more differently by expanding the opportunity set from where we are today, and rather than wholesale exclusions, thinking more about how we engage based on the holdings and focusing on the similar factors, but more a way of using that information to engage with companies in emerging markets. So today we've invited one of the experts we referred to at the last meeting, who's involved in the process that NYCers undergoes today, but that's only a very small portion of what they do and the type of work they work with clients. So we'll let Sean introduce Verite and speak a little bit more broadly about how they work with other clients of theirs and the work that they do, which is very interesting, but also talk a little bit about some of the ideas they have based on the broader view we've shared with them about the direction of the teachers board. So with that, I'll turn it over to Sean.
Great. Thank you, Mike and Robin, for inviting me, and it's a pleasure to see you all. I know you have a short amount of time, so I'll try to be quick. I'm Sean McDonald. I'm the CEO of Verite. Verite is a nonprofit organization that was founded more than 20 years ago to promote fair, safe, and legal work globally. We work concretely on supply chain practices and policies. Verite is quite unique in that we work with all stakeholders in the labor space, meaning we work directly with workers themselves, with suppliers on factories and farms, multinational corporations, investors, unions, governments, the whole range, which is actually quite unusual in the labor space. We were founded in 1995. We have a footprint of about 100 people globally, offices and places where you would expect there's a lot of our kind of work: China, Southeast Asia, South Asia, Latin America, with a headquarters of about 35 people in Massachusetts. We do things ranging from assessments and audits in supply chains to policy advocacy work around supply chain practices and policies, as well as a lot of training and consultation for businesses. What I'd like to do is really emphasize the fact that much of our work focuses on risk assessments, and if you take a look at page 4, I'll try to go through these quickly, and I'll let you know every once in a while when you should flip pages, since it's not on the screen. A lot of our work focuses on risk assessment because, frankly, where a lot of investors and companies are at the moment is still really coming to grips with their risks around the world. That could be risks related to human trafficking, to unsafe workplaces, to gender discrimination. And so for many of our clients, we really help them figure out what is their risk profile. And that can come in 4 major ways: looking at evaluating their country, commodity, or sector risk. We do also a lot of work in combining risk profiles, where you're looking at how a particular sector is actually operating in a country, because obviously conditions can vary quite a good deal between countries in the same sector. We also do a lot of individual company benchmarking, and the reason that that's important is because as more multinationals are trying to understand what risks they face in the suppliers that they're choosing, they want to be able to know how they can differentiate between which supplier may be presenting more risk to them than others. And then in our work with investors, they want to have a handle on how well the holdings they have, those companies, are understanding the risks and practically what are they doing to deal with them. And then we do a great deal of our work, more than half of our work is in direct company engagement, where the level of risk analysis is much more practical and in-depth, where we can do audits and assessments, self-assessment questionnaires, working with grievance mechanisms to hear directly from workers about what the status of the situation is, and then tailor our trainings and toolkits and consultation and capacity building for what will work to help that company deal with these risks more appropriately. On page 5, I wanted to give you now a couple of examples of the kind of risk assessment work that we've done, and then over time be able to give you some sense of how we may be able to help you transition. Since 2000, we've worked with retirement systems to understand country-level risk. So back in 2000, we worked with CalPERS in more than 25 countries. We provided an analysis of what risks existed on labor matters that was mixed with other information about countries' investment, openness and transparency and things like that, for CalPERS to decide whether they would invest in a particular country. When they moved away from that methodology, that's why we no longer work with them. But since 2004, we've worked with NYCers, and I think the important thing to note, I think some of you are familiar with the work that we've done with NYCers, is that we have a really comprehensive approach to how we do the analysis, and And what's really important is we don't just have some kind of algorithm that says, throw in some information based on publicly available sources, but we every year have in-country researchers update the situation across all the International Labor Organization core labor criteria, as well as a lot of other qualitative and quantitative factors. And then that's all analyzed by experts in country as well as at our headquarters, so that we're able to provide really valuable, up-to-date information. So that's what we provide for an organization like NYCERS. On the next page is another really interesting example, particularly for those of you who may still be in the classroom or for your teaching colleagues, where we created for the US government a website called the Responsible Sourcing Tool, where we were helping the world's largest supply chain, which is really the federal government, come to grips with how to implement President Obama's executive order that required federal contractors of a certain size to have an anti-human trafficking plan in place. Our policy team actually was very active with the White House in crafting that executive order, and then they asked us to do a full analysis of 15 major sectors globally, for which sectors were most at risk for human trafficking, analyze more than 44 commodities, and then present socio-political and economic risk information from more than 100 countries. Wrap that all together into this website responsible sourcing tool that all federal contractors and other companies could access to better understand where that risk may be, and then create open source compliance tools to help those companies figure out how to deal with this. So this is an example where our policy, company engagement, as well as research work all comes together around a particular type of risk, that is human trafficking, for a wide variety of companies. On the next page, you'll see how we took that concept and dug a little deeper into Africa, where we had a client, in this case it was the State Department, asked us to go really deep onto trafficking risk in Africa with particular criteria where they wanted us to provide more in-depth information. I think this is really important because all of our efforts end up being tailored to the needs of a particular client. They wanted us to really focus not just on the typical indicators of trafficking, but also what was the links to environmental crises, political crises, that sort of thing. And also there we worked very closely with union affiliates in many of the countries there to get really in-depth information about things from a worker's perspective. On the next page, you'll see some examples of how, with individual socially responsible investment firms or their advisors or companies themselves, were able to do risk profile information. And this is really based on, it always ends up being based on their willingness to share a certain amount of data or their comfort with digging in and getting information for companies. So, for example, one client may ask us to look at what are the risks in the electronic sector, not just generally, but specifically focused on foreign contract workers, for example, or how we could benchmark their holdings against peer companies. Because as you know, many companies will try to tell you all the wonderful things they're doing, and a lot of our investor clients really want to know, how can we really evaluate and judge the information that they're giving us? Are they basically, telling us a lovely story, but how do they really compare against their colleagues? So we also very often will do risk assessment based on the spend and the leverage of the company. Where are they putting most of their money? Where do they have most leverage in terms of the size and durability of the contracts they have? On page 9, just another quick example, focused particularly on work we do when it's just based for various reasons on public sources of information. So along with Sustainalytics and Business and Human Rights Resource Center, we created this effort called Know the Chain that evaluates companies on their human trafficking and forced labor transparency statements and efforts based on publicly available information. And then I think it's really particularly important to note that when we focus specifically on SRI firms and the information that they need, that we spend a lot of time helping them weight how they want us to evaluate their companies, so what kind of scoring methodology is created. On the next page, 10, this just gives you a really brief overview of when we work directly with companies, and that could be companies at the headquarters level, multinational headquarters level, or at the major supplier level, where we'll help them start off essentially with mapping their exposure, evaluating the levels of risks, figuring out how to build capacity or provide the tools they need to deal with these, and really focus on root cause analysis and improving their systems and processes. On the next page, I won't go into all this, but you can see a lot of the much more in-depth practical types of engagement that we have with companies, where we really help them figure out how to improve their due diligence systems, create a management systems approach, because frankly, no company deals really well with labor issues, and so it's a journey for all of them. And so really helping a company figure out in which particular supply chains, in which countries they should do which steps at what robust pace is really the kind of work that we're able to do based on the experience we have of more than 20 years working across a lot of countries and sectors. Great, so that's a really brief overview of the type of work that Verite does. On page 12, I laid out just, and 13, some basic options for the kind of engagement that we had been brainstorming. Obviously very eager to hear your questions and your comments, but we really thought that if and when you decide to transition away from a country-level screening approach, that we could advise based on our previous experience how to facilitate that transition to looking at it on a sector base or a commodity base, or actually evaluating individual companies or groupings of companies. Obviously, we would be able to give a lot of in-depth analysis based on particular sectors or commodities or countries, with that expectation that it would be based not just on desk research or publicly available information, but in-depth expertise on the ground in these countries. And also potentially, if you're trying to figure out what is the right sort of methodology for how you evaluate companies, what are the kinds of things like self-assessment questionnaires, other forms of data gathering, types of engagement, types of questions to be asked, processes even of building the capacity of your team or your advisors' teams to interact with companies to really better understand how to benchmark them against their peers, or more importantly, how to benchmark them against what your expectations and goals are for them. And I know that that can be a difficult process, but we really work with clients to say, what is your short and long-term goals with the companies that you are invested in? Are you expecting them to be above average? How important is it for you that you work with them over many years and that you see continual progress? How can you evaluate that progress, that sort of thing? Or are you going to take a more indirect approach and just try to avoid particular sectors, or try to benchmark your holdings against a certain level of performance for companies in a particular industry? So those are the kinds of things. On page 13, if and when you're interested in more direct company engagement, obviously this is work, our bread and butter, that we've done for many years, and that way we can help you benchmark, help you rank, figure out the criteria, actually engage with individual companies as appropriate, or perhaps build the capacity of you all to figure out what kind of questions you want to ask them, what level of information you want to get from them, what is the nature of the back and forth of engagement that you want to have with them, and if necessary and possible and desirable from your perspective, actually provide some capacity building or advice for the companies that you invest in to actually improve their performance. So that's really a spectrum depending on how deeply involved you want to get, or if you want to help in developing a journey, so to speak, for how you might pilot particular approaches for different sectors or companies, rather than necessarily jumping right off a cliff into direct engagement with individual companies on improving their performance. So there you have it, a couple of ideas for how you may transition based on a lot of experience that we've had doing this type of thing, and eager to hear whatever questions or discussion you'd like to have in the time available.
Questions for Sean? Yeah.
Just that this sounds great. And we started this work because we had a list of excluded countries, and we weren't really sure should they still remain on the list or, what has changed. But this also gives us the ability to make changes for some of the countries that we feel are doing the wrong thing. So this sounds wonderful. Thank you. This is very interesting.
And I'll just say, I also sit on the NICERS board
Okay.
along with the mayor's office, so we're very familiar with this, and we've had a great experience at NICERS. But one question that we've been batting around a little bit is how fresh is the data? Sort of, we have a particular way of doing things at NICERS with Callan's involvement, and it sometimes seems like we might be looking at research or information that Verite did, maybe not particularly in the most recent past. So could you kind of talk about timing a little bit, how it works, maybe how it could work, or how it should work?
Right. Yeah. So I can't speak for Callan, although my sense is some of the other types of information and analysis they provide you is based on older information. Our information is updated every year, and so it includes not just the freshest desk research available, but in-country experts who go out and do interviews with relevant stakeholders that would include government people, union officials, civil society activists, and so on, as well as a legal analysis of how laws have changed. So our information is fresh every year. Of course, certain reports or information, legal analyses and things don't refresh every year because of many things, particularly around legal statutes and so on. Changes don't happen every year, but we provide an annual refresh of how stakeholders in those countries are understanding and forecasting what may happen. So just as an example, freedom of association laws rarely change in country. And so we would note that there hadn't been a change, but we would also note that maybe a recent spate of strikes in that country should be viewed in this way or in a particular way. It can be seen as a positive sign of more strength and growth of the union sector, or it could be seen, usually in a mixed way, of course. But the bottom line is that it's refreshed every year. I think some of the other information about market transparency and things that we don't do, because we're only a small part of what Callan provides, may be based on older information. Yeah.
So I have a question. So the way our emerging market policy works is it's based on the country where a company is trading on the exchange. Right? Have I got that right?
Listed.
Yeah. So what you're talking about here, I think, is more about operations, particular supply chains. So, right, for example, there's lots of companies that are U.S. traded companies, Nike and Apple, on and on. But where their supply chain operations are in some of the countries that are considered emerging markets. So those are not considered emerging markets countries because they're traded in the U.S., but supply chain issues, are all over the world.
Of course, yeah.
So part of my question is, if we're talking about moving from a country screen to a company screen, are we limiting that to companies that are actually traded in these emerging markets? And you know what I mean?
Yeah, I mean, obviously I can't make that decision for you, but it seems quite arbitrary, really, to if you're trying to lead with your values and look at labor risk in particular or other kind of social risks, then the relatively arbitrary notion of where they're traded or where their headquarters is really sending you off in the wrong direction, because that's where, if you're saying, okay, based on our holdings and the kind of products and supply chains they're associated with, that's where you can say, okay, we're really heavily invested in electronics. And then you say, okay, what are the several countries where electronics are mostly produced that would have a risk for us? Say like a Malaysia or Taiwan or a China, and go from there. So it takes a little bit of data, but it's not that difficult.
Right.
To
So
jump,
I mean, truthfully,
leapfrog to
I think
where
that's a
your
challenge for
problem is.
us because I don't disagree with you that it's sort of an arbitrary distinction. And so really, I think, are we limiting ourselves to examining, in your case, the labor practices of companies that are traded in emerging markets, on emerging market stock exchanges, as opposed to the country where operations or supply chain or what have you take place? I mean, I think that's really a question for the board. As opposed to for Verite, because I understand you could actually provide these services for any country that's traded anywhere, including much of the S&P 500. Probably.
Right, sure. Or finding a way to slice and dice the holdings to say, okay, we see of these top 50 companies, you know, they're breaking down into electronics, food and beverage, apparel, construction, something like that, and then say of those, unless you have additional information that would say otherwise, we would be able to say the likely countries where those things are being sourced would be these 10, and then you can do an overlay to say, are you particularly interested in the country risks? Are you particularly interested in what the sector is like in that country? And how do the risks stack up there? Because even countries right next door to each other can present a quite different labor profile on whether they're, say, a sending or receiving country for migrant workers. Or the situation in China is quite different than the situation in Taiwan, even though you're dealing with the same largely Taiwanese-owned electronics companies. And so that's where, with a little bit of data based on the company, what they're selling, what the shape of their supply chain is, or as I said, other kind of ways of cutting it, where you say of a huge multinational company like a Unilever or something, you know, what are you spending most on? Or we can look at the top, say, 20 commodities that they're associated with and say, okay, here are the top 5 to be concerned with. And then importantly, that can give you a sense of, depending on the nature of the engagement, where do they rank compared to their peers? Or how are they ranked in terms of the existence or the effectiveness of their compliance system? That's probably a little bit further down the road in terms of really understanding when they say they have compliance in place, how do you judge that? But I think the country level sectoral information and commodity level information, there's a lot there that can easily be worked with. They can give you a much more nuanced picture without too much difficulty and actually without too much sharing of really, really in-depth proprietary information, because a lot of these companies have that information anyway. And so it's really about what level of comfort and leverage you have and gaining that kind of information from them. And that's where I talk about, you know, being able to advise you, say, all right, this is the information you have, these are the sources of information you think you could likely get from them based on the nature of your relationship, based on your capacity of your team to get that information, how much of a hassle are they willing to go to nag the companies, speaking frankly, to give you that information, and then say, okay, with that, we would be able to provide these kind of risk profiles for you. And once you have those risk profiles, then say, okay, what might you do with those? Because this is the situation we face with all sorts of people. You know, you can give more and more information. That doesn't mean that it's easy for companies to then turn on a dime and begin to do things differently. Or an investor to say, all right, wow, I didn't realize things were that bad. Doesn't mean that you're going to sell off or should sell off right away. And it doesn't mean that you have terrific alternatives to buy into either. So, but it gives you kind of a picture of a better picture of what you're faced with those companies. And then, you know, perhaps work through to say, okay, what do you want to do with this information? What do you want to try out over the next year or two?
So how would this work? So you would give us a list of countries, or you'd give us reports on some of these, or we would contact you when there's an investment coming up in a country that we didn't normally invest in? Like, how does that work, or how does it work with NYCers?
Yeah, well, with NYCers, for example, we have a set of countries. They've changed a little bit over the years, but it's 25, sometimes it's been 23 countries, so it's the routine set. I think it really depends on, you know, first determining what your goals are, but certainly we're able to provide country level, sectoral, commodity level, or information that's based on the type of company and the kind of information based on their compliance profile. And what I mean by that is, what are they doing or not doing to deal with these problems? What kind of confidence can you have in the fact that they are moving in a positive direction or not?
So it would be, so if we wanted to invest in one of those countries, we would say, okay, we're looking at this country now. Has there been any change, or is there?
Right.
I don't think that it's sort of that one-off. Like we would have Verite as a consultant every time we're looking at a country. It would be if we decide to kind of go. It seems like on page 12 there could be a discussion about what kinds of things we want to look at, whether it's the sector level, the commodity level. And once we get past that discussion, then they would do like an annual report for us that would help inform our guidelines. So it's not on a case-by-case basis. It would probably be, yeah, it would probably be a regular review.
Sean, I'm impressed with your presentation, and I'm impressed with you. And I have a question. Thank you for coming, by the way. This is great.
Sure.
And you talked about food and commodity and food and beverage. Let's say we invest in a company that transports food and beverage from the U.S. into Mexico, let's say, and through that corridor between Ciudad Juarez and Mexico City, and then up to Yucatan or Acapulco. There are criminals and there are bandits, and there are people kidnapping truck drivers. You did mention that you have in-depth expertise on the ground.
Yeah.
So other than the published reports, and a lot of crime, what's happening in Cancun now, a lot of the crime is just not reported in Cancun. It's a terrible crime situation there now. There are bombings of, the ferries going between Isla Mujeres and Cancun. We're not hearing any of this.
Right.
So when you mentioned you have in-depth expertise on the ground, what does that mean? I mean, how would you know about things that are happening locally?
Right. It's ironic you mentioned that, because that's a situation we're facing right now with some of our colleagues in Latin America, that we have to change our protocols and people's public profiles sometimes, so that they don't get into trouble as they're poking around on some of these issues. So specifically, we have people from those countries who work with us as consultants usually, or as staff, who have their finger on what's happening there. And so, as an example, in a place like Mexico, we were hired by a company to do an assessment of migrant workers from Northern Triangle countries, Guatemala and El Salvador and Honduras, going into the coffee sector in Mexico. And so there we would have people who spoke the indigenous languages of Guatemala in particular, go into Mexico with people from Mexico who do work for us, that would go and assess this information. And they would get information both at the community level by talking to church people and local nonprofits, as well as the companies. And so these are people who are really in-depth expert on labor issues. Now that some of those same people may then spend the month of September and October doing these interviews that then go into our NICERS reports. So because of the diversity of engagements we have, our people get exposed to conditions from a lot of different sectors. And then, as I mentioned before, they're interacting with workers one day, with CEOs the next, or with government people. Not all of them, some specialize, but those are the type of people we have. And then in terms of the really specific criminal gangs and so on you mentioned, then we tailor our work so that our people aren't put into too much danger, but we certainly analyze the nature of their situations and then highlight that in the risk information to the company, but then also try to figure out what's an appropriate thing that can be done under those circumstances, based on those challenges, but also particularly from the angle of workers. We're not there to say, a 10-point plan on how you deal with criminal gangs, but rather looking at what does this mean for the workers, what additional risks are they facing, what does this mean for what you should be expecting companies should have to be dealing with this. because many companies actually would kind of throw up their hands and say, yeah, it's really bad, we don't know what to do. And that would be a problem, because it doesn't mean they should have a solution necessarily, but they should be trying things and having a continuous improvement process.
You couldn't have answered it better. I mean, just knowing that in southern Mexico, in a lot of the counties in Mexico, so many people are not Spanish speaking. There are so many indigenous languages and cultures.
Right.
So your answer,
it's a really challenging situation, because there's a lot of violence against people dealing with these kinds of issues around the world, and so we have to be really very careful.
the fact that you said they have to go in and get to know the local people and the culture before making any decisions, and making decisions as an insider. Impressive.
Yeah.
Good to go.
So Sean, we also have a country screen in our private market investments as well. How would you be able, or would you be able to help us with that? For example, if you were going to do some infrastructure investment, you know, in Honduras or something like that. Currently we have one kind of setup, and we're interested in reevaluating that. How or would you be able to help us in that?
Yeah, definitely. The issue of construction is one that's getting a lot more attention in recent years because of the dirty, dangerous, and difficult nature of the work, and because very often there's a link to trafficking, because so many foreign contract workers are involved, whether it's construction here or in the Middle East or elsewhere. And so without a doubt, we would be able to mix that information about what we know about the country with the particular construction scenario in that country, and then also, again, look to see what due diligence is in place, if anything, for that. In some cases around construction, we've even played an on-site role as grievance advisors for really large construction projects because of the nature of the difficult situations at.
Other questions for Sean? Okay. Well, thank you so much for coming in.
Thank you.
And,
Thank you. I appreciate it.
We'll be hearing from you at some point in time.
Thank you.
Nice to see you.
He's broken. And thank you for your patience this morning. Okay, if I'm not mistaken, that concludes our public agenda. We do have provided for executive session, so a motion would be in order to enter executive session.
So moved.
Jump the gun, buddy.
I'm going to not recognize the motion.
I guess I jumped too far.
I move pursuant to Public Officers Law, Section 105, to go into executive session for discussions on specific investment matters.
Thank you, Ms. Penny. Is there a second?
Second.
Thank you, Mr. Brown. Any discussion? All in favor of the motion to enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Okay, we're back in public session. Susan, would you please report out of executive session?
Certainly. In an executive session, there was a discussion on a regulatory matter. Consensus was reached, which will be announced at the appropriate time.
Thank you so much. With that, I think we conclude our agenda for today. Is there a motion to adjourn?
So moved.
Thank you. Is there a second?
Second.
Thank you. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say nay. Any abstentions? The motion carries. The meeting is adjourned. Thank you very much.
Thank you.